Warren Buffett, the legendary investor, is widely known for his immense wealth and expertise in the investment world. Surprisingly, he has been quite open about how he accumulated his fortune. As the CEO of Berkshire Hathaway, Buffett is here to share his wisdom on how to make millions with just a small amount of money. What's even more impressive is that he claims you only need to invest in 3 stocks to achieve Lamborghini-level success. According to Buffett, the key to his remarkable success lies in value investing. This strategy involves identifying stocks that are undervalued by the market and holding onto them for the long term. And when we say long term, we're not talking about a few months or a year. We're talking about patiently waiting and watching these stocks grow over the course of years or even decades. So if you're looking to follow in Warren Buffett's footsteps and potentially grow your wealth, it might be worth considering his approach to value investing. Remember though, it's always important to conduct your own research and make informed decisions before investing your hard-earned money. Hello and welcome to Only Stocks, the channel dedicated to providing you with the latest news, insights, and analysis from the ever-evolving world of the stock market. We understand that the stock market can be a complex and intimidating landscape to navigate, which is why our team of experienced analysts and industry experts is here to break it down for you in simple terms. From company earnings reports and market trends, to investment strategies and emerging technologies, we cover it all to ensure that you stay informed and ahead of the curve. So whether you're a seasoned investor or just starting out, join us as we explore the exciting world of stocks and uncover the opportunities that lie ahead. Don't forget to hit the subscribe button and turn on notifications to stay up to date with our latest content. Thank you for tuning in to Only Stocks, and let's get started. In a world where everyone wants instant riches, those who possess the virtue of patience are the ones who reap the greatest rewards. It's not just about being patient though. You also need persistence and the ability to resist the urge to bail when the stock market hits a rough patch. It's like the situation we're facing right now, with recession signals flashing before us. Yet some people still hold on to the belief that things will be different this time and the new bull market is on the horizon. So grab your calculators and prepare to take some notes, because we will unveil his secrets to making millions. He believes in the power of finding undervalued stocks and investing in them. It's a methodical approach, one stock at a time, with the potential for substantial returns. Remember, it's crucial to keep a level head and not be swayed by short-term market fluctuations. With the right mindset and Warren Buffett's guidance, you might just find yourself on the path to financial success. Now, let's dive into the heart of Buffett's investment philosophy. Instead of chasing quick profits or trying to time the market, he focuses on the long game. His strategy revolves around buying and holding stocks for extended periods, even stretching into decades. The key to his approach lies in his belief in the power of compounding. Buffett grasps the concept that the longer he holds onto stocks from high-quality companies, the more time they have to grow and generate significant returns. To identify these companies, he employs a value investing strategy. This means he seeks out companies whose stock prices are lower than their true worth, as determined by factors like financials, assets, and earning potential. In simpler terms, he buys these undervalued stocks with the expectation that the market will eventually correct itself, and the companies will reach their full potential. When this happens, their stock prices rise, leading to substantial returns. It's truly remarkable how Buffett has a knack for investing in struggling companies and turning them into profitable ventures. But it's not a blindfolded game of chance. He takes the time to thoroughly understand the companies, their potential, and their risks. His decisions are grounded in extensive analysis and research, while he resists the temptation to jump from one hot stock to another. However, it's important to note that buying these types of stocks is just one part of the equation. Buffett takes a different approach when it comes to diversification. While many investors prefer to spread their money across various stocks and industries to reduce risk, Buffett believes in holding a concentrated portfolio of stocks. He thinks that diversification can actually dilute returns and result in mediocre performance. Instead, Buffett prefers to focus his investments on a
a select few companies that he deeply believes in and trusts. He doesn't see the need to own a large number of stocks just for the sake of diversification. He views diversification as a protection against ignorance. If someone wants to ensure that nothing bad happens to their portfolio in relation to the market, owning everything may seem like a safe approach. However, Buffett believes that if you truly understand how to analyze and value businesses, it's not necessary to own a large number of stocks. In his view, it would be irrational to invest in 50, 40, or even 30 stocks because there aren't that many exceptional businesses that can be fully understood by a single person. He finds it illogical to invest in less attractive businesses when there are outstanding ones available. For Buffett, owning one stock but a business that he thoroughly knows and understands brings him comfort. He questions the need to own multiple stocks for proper diversification. Within Berkshire Hathaway, he could easily pick 3 of their businesses and be perfectly content if those were the only ones they owned. Having 3 wonderful businesses is more than enough to achieve great success in life, and the average person won't encounter any issues with such an approach. If we take a look at how fortunes were made in this country, they weren't built by having a portfolio of 50 companies. Instead, they were built by identifying and investing in a few exceptional businesses. Coca-Cola is a prime example of a wonderful business that has created numerous fortunes. The truth is, you won't find 50 or even 20 companies like Coca-Cola. If there were, then diversifying among them would make sense. But that's not the case. Exceptional businesses have built-in protection against economic fluctuations and competition. Investing in 3 of these outstanding businesses is better and safer than owning 100 average businesses. It's surprising how modern finance courses teach diversification as the key strategy when in reality, owning a few wonderful businesses can be more lucrative and secure. Of course, concentrating your portfolio comes with risks. If one of the stocks experiences a significant decline, it can impact overall returns. However, according to Buffett, the potential rewards outweigh the risks. He also suggests that most investors who aren't willing to thoroughly research stocks should stick to low-cost index funds that track the S&P 500. These funds provide average returns, which at around 7% annually are quite respectable. Just compare that to the recent drops of over 50% in cryptocurrency prices. His approach challenges the conventional wisdom of diversification and emphasizes the power of identifying and investing in exceptional businesses. Let's delve into how Buffett used his investment strategy to make millions with 3 specific stocks: American Express, Coca-Cola, and Wells Fargo. In the 1960s, American Express faced a crisis called the Salad Oil Scandal, which caused a major downturn in the futures and commodities markets. Many investors panicked, causing Amex stock price to plummet. However, Buffett saw an opportunity in this chaos. Recognizing Amex as a great company with a solid competitive advantage and a loyal customer base, he decided to invest when the stock was at a low price. Ignoring the scandal temporarily, he trusted his instincts and bought $1.3 billion worth of Amex stock. Buffett held onto this investment since 1995, and it has grown to over $22.4 billion, resulting in a remarkable 17 times gain, with an estimated dividend rate of 23%. This showcases the power of Buffett's value investing approach. Moving on to Coca-Cola, Buffett invested in the company in 1988, a time when it was not as popular as it is today and was still recovering from the crash of Black Monday. Despite its severely devalued shares, Buffett saw the potential in the brand and decided to invest $1.3 billion, acquiring a 6.2% ownership by 1994. Today, Coca-Cola is a globally recognized brand, which once again highlights Buffett's keen eye for potential. His investment in Coca-Cola has paid off tremendously, with its stake now estimated to be worth a staggering $24 billion. And let's not forget about the dividends he has earned over the years, totaling around $10.2 billion or a 54% annual rate. Moving on to Wells Fargo, Buffett was attracted by its low price and strong management. Seeing the bank's potential, he started investing in Wells Fargo in 1989, initially putting in $290 million for a 9.7% stake. By 1994, his stake had grown to 13.3% due to continuous investments during the housing crisis. Despite facing corporate issues, controversies, and divergence in moral values, Wells Fargo remained one of the largest banks in the world. Buffett's investment in the company proved highly profitable through dividends and stock price increases. In 2016, his share in the company peaked at $12.7 billion, with a market value of $22.1 billion. However, due to various reasons, including corporate corporate issues and controversies, Buffett cut ties with Wells Fargo in early 2022, selling most of his stake. Nonetheless, he still earned billions in capital gains and received dividends from holding the shares for almost 30 years, approximately 8.6%. So why did these stocks align with Buffett's investment philosophy? Well, they were all high-quality companies with solid fundamentals that he understood and trusted. Furthermore, the market undervalued their prices for various reasons, making them attractive opportunities for Buffett to capitalize on and hold onto for the long term. Today, these stocks continue to perform well, with Coca-Cola and American Express considered blue-chip stocks, and Wells Fargo, despite recent challenges, still playing a significant role in the banking industry. Investing can be a challenging endeavor, but by applying Buffett's investment principles, which have become a blueprint for many investors, one can guide their portfolio towards success. The key is to focus on long-term investments and seek out high-quality companies with strong fundamentals that the market may undervalue. His investment strategy revolves around long-term investments, emphasizing the importance of patience and avoiding frequent trading. Instead, he encourages investors to focus on a company's fundamentals and its long-term potential, disregarding short-term market fluctuations. Quality is a key factor for Buffett, as he shifted his approach from quantitative-based investing to quality-based investing with the guidance of his business partner Charlie Munger. Rather than settling for cheaply priced mediocre companies, they seek out businesses with strong underlying quality that can drive long-term performance. Investing is never a guarantee, but following these principles and staying focused on long-term goals can increase the likelihood of investment success, as demonstrated by Buffett himself.
As always, thanks for tuning in. I hope you found it informative and valuable in your investment journey. If you enjoyed this video, please consider subscribing to our channel to stay up to date on the latest insights and analysis on the stock market. Also, don't forget to hit the like button and share this video with your friends and family. Remember, investing in the stock market can be complex and risky, but with the right information and tools, you can make informed decisions that could lead to substantial returns. See you on our next one.